Hello and welcome. So today I'm going to be trying something a little bit different. It's mostly been sort of Excel problem solving so far. Today I'm going to do something a little bit more like a classic financial model. As you might know, the Financial Modeling World Cup, the people behind a lot of the questions I've looked at so far, are starting their new season this weekend. So 2022 is kicking off. They've released the question guide, and one of the questions this weekend is going to be about a debt waterfall. So I thought, why not go back and grab one of the old debt waterfall questions, make a quick video on that, and I get to warm up, and who knows, maybe help my competition as well. Several caveats before I jump in, which is there's a little bit of an experiment. I'm not totally sure that a financial model is going to work in this format in the way that I think the problem-solving questions sort of have, basically because there's a lot more in a financial model, meaning both, there's a lot more instructions, like loads and loads of detail rather than just one big idea, as it is with a lot of the problem-solving questions. There's also, various kind of tabs of assumptions, and then once I actually build the model, it's, there's going to be lots of rows, lots of columns. It's going to be very large. I'm trying to keep my screen, at a size where you can sort of still read what I write in the formula bar, even if you're not watching this on a huge screen, and where you can still read what's going on here. But I don't know. I don't know if there's going to be enough space in here to make this work. I'd be curious to hear what you think. Maybe you can handle it a bit more zoomed out. I've got pretty good eyesight. I could probably handle that, but like I said, ideally I'd like it to work if you're watching it on a phone as well. So I'm going to give this a try and tell me what you think. So when we get one of these cases in the competition, we get basically three things with it. One is the workbook itself that has the assumptions in here and a place to build a model. One is the instructions, which are usually a few pages long, which these ones are. And then the third thing is a set of questions that we have to select answers for. So in the interests of fitting everything in, I've put the instructions up there, and I'm going to scroll along to the kind of relevant pieces as we go. The model is over here. That's obviously the big piece. And then I've got the questions here on a piece of paper. So if I'm feeling confident that I've got the answers right, then I'll check some of those. All right. So anything else to mention? No. Oh, yeah, sorry. One other thing to mention, given the space constraints, you're obviously not going to see best practice in terms of model design and layout. I'm just going to be squeezing everything in. So, you're welcome to, if you feel like you can learn something from the mechanics, great. You definitely won't learn anything useful from how I format this model, because there's just not room for it. So, having said all that, a little bit of kind of general background there that you don't really need, but a quick overview. So we're talking about modeling a hydropower plant. It's just been built and it's about to start operation on October 2021. We want to model 20 years of operations with a quarterly model, and we're going to work out basically the repayments of the various different bits of debt and then equity distributions and so on. So there's some assumptions laid out here and correspondingly in here. Again, I'll go through each one of those as we come to modeling that piece, but just to give you a high-level sense, there's some assumptions here about the project revenues, about the general debt structure, specific details about the senior debt, specific details about the subordinate debt, specific details about the revolver, revolving line of credit, specific details about the equity piece, and then this is the waterfall that gives it its name, which is, in other words, the order of precedence that says, okay, so money comes in, first it goes here, and then it goes here, and then it goes here, and then if there's anything left, it goes here, and so on now. So that's what we're going to be trying to model. Let me do some very quick setup on the model sheet, and then I'll kind of dive on in. So first thing is we've got model start date, and we want to do 40 quarters starting from there. So I'm just going to put in a quarter start, with a T, and a quarter end. I'm going to leave one blank column to put in kind of helpers and other things like that. So I'm going to put my first start date there, and just in the interests of squeezing everything in, I'm going to drop the day and just show the month so I can make it a little bit smaller. I'm going to make that one red just because it's going to be a different formula from the rest of the row. And then I'm going to say the quarter end. So EO month gives you the end of the month, a certain number of the date at the end of the month, a certain number of months after. So in other words, it starts in October, so 2 months later is December. I want the end of December, and again I'll do that, and this one's going to be black, and then I can just say that +1 and copy that across, and then I'm just going to do a quick sequence to give me the size of it. So copy it across to there. Oh, actually, I guess you can tell that I've been pre-playing around with this because I've already hidden all the columns to the right of that. So basically, if you hide all the columns further over, then from now on, whenever I do a formula, I can just Control-Shift across and then Control-R, and that'll copy it. So then I'm going to freeze my panes so that I can always see the date and the labels that I'm going to put over here no matter where I go, and then I'm ready to start modeling. Okay, so part one is the project revenues. So let me just flip to the corresponding assumptions here. So annual CFADs for 2021, if it had been running all year, would be 40 million. That's that number. We call this CFADs, cash flow available for debt service. It's expected to grow by 2% a year. That's that number there. And then assume no capex, no taxes. So in other words, the cash flow available for debt service is just equal to the EBITDA, earnings before interest, taxes, depreciation, and amortization. I see, I'm a finance guy, almost. And then there's seasonality here. So you get 25% of the revenues, of the annual revenues in Q1, 35% in Q2, 20% in Q3, and 20% in Q4. So, having said all that, the first thing I'm going to do is do an index. And that will start off with a value of 1 in 2021. And again, I'll just make that red because it's a different formula from the rest of the row. The reason I mention this, if you're not kind of familiar with financial modeling, is by and large you expect to be able to kind of copy everything across and for there to be no changes in the formula going across. That's a kind of pretty important modeling best practice. And then, so the 2% increase applies from the start of each year. So here's how I'm going to do that. I'm going to say equals this times 1 plus, and then I'm going to say if month of the start of the quarter equals 1, then give me that 2%, otherwise 0. Oh man, my formula bar is so narrow. So if the month is January, then we're going up by 2%, otherwise we're not going up. And then I copy that across, and I'll just format that to 2 decimal places, so you can see over the course of the 20 years that gets it up by almost 50% over the start. Then seasonality, and here I'm just going to say index this. So this is already laid out Q1, Q2, Q3, Q4. So again, I'm going to use month, and this time I'm going to use the month at the end of the quarter, so I see $2. So basically the month at the end of the quarter is 3 times the number of the quarter. So that gets me my 20% for Q4, 25% for Q1, 35% for Q2, 20%, 20%, and repeat. So that's working nicely. And then finally, my CFADs. That is going to be the index times the seasonality times the annual amount. And I'm just trying to make this as... see, I'm hitting more constraints here with the size, but never mind. We'll do the best we can. Actually, you know what? I'm going to do the CFADs in thousands. What are we doing? Dollars, I think? Yes, dollars. I'm going to do the CFAD. I'll do everything in $K. I'll fit in a little bit more. So now we can go back to the size we were before. So copy that across. I think March 22 is the widest column. And now you can see a few more dates. So, all right. So, and quick sense check. The first question is, what are the quarterly CFADs in Q1 2022? 10,200,000, and that's what we got. Hooray. And total CFADs over the whole period, the answer is supposed to be $987,445,109. So I've hidden the decimal places, but I'm feeling pretty good that that's right because I've got it as far as that. All right, so moving on. So the first thing that we're going to take off, so quick overview of the debt structure. 2 tranches of debt, senior and subordinate. Interest and principal payments happen quarterly at the end of the quarter. Senior debt is linked to NIBOR, which is the Niagara Interbank Offered Rate, and we've got a forecast of that over here, somewhere here. Yes, here. So you see we've got a forecast for some future dates there, and we're told to assume that the rate gradually increases between those dates in equal increments per quarter. So in other words, if it's 1% at the start of 2023 and 2% the start of 24, then it'll go up 0.25% per quarter. And we're told always assume simple interest rates of 33.60. So let's think about how would we calculate this NIBOR rate. So a couple things. One quick thing is this format, a bunch of dates mixed with a date and thereafter is horrible. So I'm going to kill the and thereafter. I'm just going to cut and paste this down a little. I'm going to say starting date, or what was it, effective date, I guess. Date from. Keep it simple. And rate. So, in other words, at the start of the first quarter, it's going to be 0.5%. The start of the next quarter is going to be 0.67%, and then over the course of that year, it'll go from 0.67 to 1, over the course of the next year to 2, over the course of the next year to 3, over the course of the next year to 3.5, and then thereafter it'll be at 3.5. So how are we going to model that? Well, the way I would suggest is, first of all, let's just, we'll put it here. Again, if this was a less space constrained model, it's a good idea to have a units column where you would put like $K, percent, and other things, but I do not have that kind of space, so I'm not going to. So first thing we could do is a straight VLOOKUP on that into here, and this is mostly just to show you what's going to go wrong. So you pull that in, and sure enough, in the first quarter you get that, second quarter you get that as you expect, but then after that you've got an exact match, so it's mostly errors. So then think about what you want to do, right? You want the formula to be this, where it's an exact match, and then go up in steps where it's not. So actually a good structure for this is going to be an if error wrapped around that VLOOKUP, with then X being some way to handle the progression in between. So then let's think, how do we handle that progression in between? Well, we need to go from 0.67% to 1% over the course of 4 quarters. Now, as it happens, these are all 4 quarters in between, but let's try and not hard code that assumption. So let's say quarters to next, and then we're going to want the increment per quarter. So in other words, how much does it go up every quarter in between when it takes on this rate and when it takes on this rate? So for the quarters, I'm going to use year frac. Year frac is a super helpful function. It gives you the fraction of a year between 2 dates. So in other words, here it's from the start of the last quarter in 21 to the start of 22. That's a quarter of a year, and then for the rest, it's all obviously 1 year. And I'm going to take that, I'm going to multiply it by 4, and that's going to give me my number of quarters. And then the increment per quarter is just going to be the new rate minus the old rate divided by the number of quarters that it changes over. And again, I'll make that a percent to 2 decimal places. So in other words, here it goes up by the whole gap of 0.17% in 1 quarter. Here it goes up by 0.08% per quarter for 4 quarters. Here it goes up by 0.25%. So again, this is actually kind of the exact example. So it goes from 1% to 2% over a year, so 0.25% per quarter. And then I'm going to deliberately leave this, let me just fill it in as gray, just to say, that's being deliberately left blank. So in other words, it's 3.5% forever after January 26, so the increment per quarter after that is nothing. So, and now we're in a position to finish off this if error. So I'm going to say, and just to mix it up, because I like to champion the case for VLOOKUP every now and again, but obviously there are real reasons not to use it. So let's do an index match for this piece to make the VLOOKUP haters happy. So sorry, first things first. So what do we want to say? We want to say if there's an exact match, then take that. If that's an error, in other words, if we're in between, then take the previous quarter plus the change. And to get the change, we're going to do that index match. So we're going to say index, we're going to match the quarter start date against the list of quarter start dates, but that's not going to be an exact match. So it's going to be comma 1, or just leave the second argument blank. And then what are we indexing on? We are indexing on this increment per quarter. So, and then I think I'm missing one closing bracket. So now let's see if that's working. If it is, we should go up by 0.08% here. Seems to be working. There, and then we get, and it smooths into 1. And then we go up by 0.25% a quarter. So let me just stretch this out. Again, I'm not not trying to argue for any kind of one method over another here, which is why I'm mixing my VLOOKUPs and my index matches. The whole point is that you can use lots of different things. But the idea is, say if error, so first try to find an exact match. That's what that (0) is doing, exact match. If there's not an exact match, that means you're in between quarters, so you take the previous quarter's amount and you add with this different kind of lookup, which again, the important thing is (1) non-exact match, range lookup, is going to give you how much are you going up in between the quarters at that stage. So then we just copy that across, and you can see at the end it flatlines at 3.5%. So that's exactly what we want. Realizing that if I explain all my formulas this much, this is going to take me a very long time, but I guess that's what I'm supposed to be doing. I don't know. TBD. So anyway, we've modeled NIBOR, so hooray for that. Let's move on. Interest for each debt instrument is fixed on the first day of the quarter. That's fine. Okay, so now we can model senior debt. So let's get on with that. First things first, let's take a look at the assumptions. So starting amount is 250 million. We got that here. Senior debt repayment should be sculpted with a target debt service coverage ratio of 1.75%. That's this number here. And it explains here the debt service coverage ratio is EBITDA, which again we've talked about is the same as CFADs that we've already modeled, divided by interest plus mandatory principal payment. So it gives an example here. If you had quarterly EBITDA, which is CFADs of 17.5 million, you divide that by the debt service coverage ratio, so your total debt service should be 10 million, and let's say you have 4 million of interest payments, then your principal payment will be 6 million. So in other words, to get to the mandatory principal payments, the interest rate we know, it's a spread over NIBOR, so we can calculate this piece, we already have, and what we need to figure out is this piece, the mandatory principal payment. So the way we're going to do that is we're going to take our EBITDA, basically rearrange this equation, divide by the debt service coverage ratio, and then subtract off the interest, and that's going to be the mandatory principal payment. So let's have a quick look at that. So first things first, I'm going to try to be vaguely good about my layout, subject to the caveat I made earlier that the layout's going to be terrible. So, senior debt. Let's just go with the usual suspects. Opening, repayment. Actually, sorry, there's mandatory repayment, and repay. And then there's an accelerated repayment talked about later, so I'll just put that in now. And that gets you to closing. Then we calculate the interest. Well, let's do the int rate first, because we figured out NIBOR, but we still have to figure out the exact spread, which I think it mentions that further up here, I think. Let's check. Yes, 2.5% above NIBOR. Yeah, we have that here. So the interest rate is going to be that NIBOR that we calculated plus that 2.5%. Lock that in, copy across. So again, just as you would expect, this flatlines at 3.5%, so this flatlines at 6% at the end. This starts at 0.5, that starts at 3. So vague sense checks, that's kind of working. So then interest, that's going to be the opening balance, because it mentions that any principal repayment happens at the end. So your opening balance is your balance throughout the quarter. So it's your opening balance times that interest rate divided by 4, because it says somewhere up here, 3360 assumption. In other words, assume every month is, where is it? It's in here somewhere. Here it is, 3360 convention. So in other words, if the annual interest rate is 4%, the quarterly interest rate is 1%. So we just divide. And then we copy that across, and we will format that quickly. So then the opening debt at the start of October, that's one of our assumptions, is this number. So big. So yeah, said we were going to do thousands. Still going to need to make my column a little bit wider, but hopefully not too much. And again, I'm going to just make that a different color to distinguish from the formula for the rest. And then the closing is just going to be the sum of the opening and the different repayments. The opening the next month is going to be the previous month's closing. And then we can just copy both of those across. So now we have actual interest payments. So now, let's say target debt service. Target debt service is your CFADs divided by this 1.75, which we'll lock in. And again, we'll format that and then copy it across. So then my mandatory principal repayment is going to be my, before I do that, there's another piece in here about this. So there's one mandatory principal repayment, which is at least get to the debt service coverage ratio, and there's a second one, which is senior debt should be repaid within 15 years. Every quarter's mandatory principal payment should not be lower than 1/60th of the initial balance of 250 million, even if that means the DSCR is not reached. So, all right, let's just say mandatory by DSCR. That's going to be target debt service minus the interest. And then we're going to have mandatory by term, which is going to be the initial balance divided by the number of years divided by 4, because we want a quarterly amount. And again, format that, copy across. Oh, sorry, I gotta also divide that by 1,000. Gotta keep consistent with my formats. And then copy that across. So now my mandatory repayment will be the larger of these two. And it's going to be negative, obviously. And now if you're an experienced financial modeler, you'll immediately see what I've just done and say that's a howling mistake. But if you're an amateur, it's quite easy to spot when you copy it across that now you've paid off much more than all the debt there is. So it's important at some point to stop paying off when there is no more debt. And the way that we model that is to say the minimum of that required repayment, well, you can't ever be required to repay more than the debt that is outstanding. So we do that, and then we end up with zeros at the end. And the fact that those zeros are showing as zeros is going to remind me that I want to put in a number format that does that differently. So I'll do that, and that looks a little nicer. And I'll do the same here. Okay, good. So now we've got our senior debt modeled. Let's go do subordinated debt. So subordinated debt. And let's have a quick read about that. The starting amount is 70 million, and we can go and see the assumptions here. Starting amount is 70 million, good. Includes all the interest accrued and yada yada yada. Repaid in equal amounts over the 17.5-year time frame. So that's the time frame there, equal amounts. If part of the subordinate debt is repaid early, the repayment term doesn't change. Instead, mandatory quarterly repayments become proportionally smaller. So in other words, right now it's going to be that divided by 4, which will be $1 million per quarter. If, let's say, I paid off half of the loan, then the mandatory repayments after that would be $500,000 a month. Sorry, $500,000 a quarter, so that you'd still be paying off the same proportion of what's left. So let's just do a quick remaining periods. And for that, I'm going to say sequence. I mean, you can just start with this times 4, and then say equals that minus 1. Again, if I'm doing a different first formula, I just do that, and then copy that across. And again, you're going negative here, which isn't what you want, so you'd say max of that and 0. And again, just format so my zeros go away. Oh, that one didn't. That one didn't either. All right, well, see, I've been a little sloppy about my formats, but never mind. All right, so that's the remaining periods. So then the proportion to repay will just be the opening balance divided by that. So now, again, usual suspects. Opening, so we've got a mand repay, an accelerated repay with an A, and then a closing, exactly the same as the senior. And we'll just copy that format as well. So again, my opening is just going to be a fixed thing pointing to here, and again divided by 1,000. My closing is going to sum up that, and copy across, and my opening the next period, previous period's closing, copy across. So the mandatory repayment is going to be if this equals 0, then 0. Otherwise, this divided by this. I'm hesitating a little bit here because I'm thinking, do I need to check if this is 0? But this has to get to 0 no later than when this gets to 0. So if by putting in the check for that one being 0, I automatically do the check for the other as well. And of course, this should be negative. I don't need to put in a cap on this one because this is always paying off a proportion of that, which is never greater than 1. So here we go. If there's no accelerated repayment, it gets paid off over 70 periods, and we get to 0. Happy days. Then, oh yeah, so the interest on this one is funky. So the interest rate of subordinated debt is fixed at 6.5% for the first year. Starting from the 5th quarter, it is adjusted based on risk as measured by your total debt over EBITDA. So 6.5% for the first year. So let me just iterate. I'm just going to quickly, again, I'll format to highlight it's different, but I'm just going to link that here. Probably more elegant ways you could do this if you weren't in competition time, but that will do. And then after that, it is adjusted according to the debt to EBITDA ratio. According to this table, so if you're less than or equal to 1.5, it's 5%, less than or equal to 2, it's 5.5%, so on up, and then there's a big jump if your debt to EBITDA gets over 4. So again, much like this table up here, I don't really want text in there. I want to be able to do a lookup on this. So if I were being more elegant about it, I would probably use a formula to extract this, but instead I'm just going to replace star equals with nothing. I don't obviously want it formatted as a date. I don't know why I did that, but never mind. And then just here, I'll take that out as well. Now the important thing is, this is if it's greater than 4, this is if it's greater than or equal to 1.5. So the way I want it structured for a lookup table is actually to shift all these down. So in other words, starting from 0, it's going to be 5%. Then if I get above 1.5, then it's going to be 5.5%. Then if I get above 2, it's going to be 6%, and so on down. Quick word of warning that in deleting the text there, I glazed over an edge case. If I structure the lookup table in this way, it will say at exactly 1.5 it's 5.5%, but actually the way it was worded, at exactly 1.5 it should be 5%. But if you look at the size of the numbers and the way this is being modeled, the probability of it landing on exactly 1.5 or exactly 2 or exactly 3 is approximately 0. So I'm being a little lazy. There are ways that you could allow for that, but I'm not going to do that today because life is too short. So what is this rate? We want debt to EBITDA, and we want last 12-month EBITDA. So again, I'm just going to just make an exceptional formula there that says not applicable. And now the other thing that we need is our debt is going to include our revolver. We haven't modeled it yet, but we can just put in a shell so that we have the placeholders that we're just going to want open, change, or you could separately do drawdown, repayment, and closing. So then our total debt is going to be we look at the opening balance because we set the rate at the start of the quarter. So the opening balance of that plus the opening balance of the subordinated debt plus the opening balance of the senior debt, which is up here. So that's my 3 debts, and then I'm going to divide by the last 12 months EBITDA, which is CFADs. And again, I'm setting it at the start of the quarter, so I'm going to look not including this quarter, but starting from the one before. Gives me that. So 7.3 roughly. And so then my interest rate is going to be a lookup. So I don't know, are we feeling index match? Are we feeling VLOOKUP? Are we feeling something else? I'll do a VLOOKUP because I just prefer it. What can I say? But tell you what, just again another little sop to the VLOOKUP complainers. Rather than putting in a fixed column number, I'm going to put in columns of the same reference. Sorry, not 0, comma 1, or just blank. And that's my so just quick explainer of what happened there. So one of the complaints that you'll hear about VLOOKUP is that if you say let's just copy this over. If I just said I'm looking in the third column, that looks up 12.5%. I come over here at some point later, I insert a column because I'm doing something else, and oh, now this is broken. But this formula here, so if what you want is from the last column of the range, then you can use this formula columns and just repeat the same argument that you put in here. So what table are you looking in? You want it from the last column, and then you can see this one still worked after I inserted that column. Anyway, that's an aside. Copy that across, so you can see you start off with this sort of punitive interest rate for a little while, and then as you gradually pay down debt, at some point it comes back down into the realm of the 6.5s, and then back to 6, 5.5, 5, etc. Okay, so then I've calculated the interest rate. Let's calculate the actual interest, which again is just going to be the opening balance times the interest rate divided by 4. And I'll take one of these many formats, copy it across. Okay, let me just see if there are any questions. The reason I say this is because a good way to check that you're not going too crazy as you go along is to take a look at the questions and see, are you getting them right? So let's see, what is the mandatory repayment amount for senior debt in Q4 21? So back up to our senior debt, Q4 of 21. So that's that, and it's supposed to be 4166667. So again, I'm hiding decimal places, but take my word for it, or I can even expand them out and you can believe me. And then the next question is, what is the mandatory repayment amount in Q2 of 22? And the answer is 6194948. So again, that seems to be working. Cool. So again, that's just a way to check we're on the right path. And what is the highest amount of quarterly interest paid for senior debt in any given quarter? So this is an interesting one because if you remember, the interest rate is gradually ticking up, but our balance is ticking down. So you got to find where it peaks. And you can just quickly select and look at the max is 2611, which is what it's supposed to be. Mandatory repayment amount for the subordinated debt in Q2 22, that is probably going to depend on figuring out accelerated repayments. Right now it looks like $1 million, but our answer is supposed to be a little bit less than $1 million. So we need to do the cash flow waterfall before we can get to that. Okay, so that is up to the accelerated payments, which will require the waterfall. That's the subordinated debt model. So now let's quickly do the revolver, and then we can do waterfall. So the revolving line of credit, in case the project is not, if you can't cover costs, then you can draw on the revolver, not to make accelerated payments, but only to make mandatory payments, interest payments, etc. Starts off at 0 with an available balance of 5 million. Now, one very important thing, which you got to be careful with. You should obviously model a cap on the revolver, but then the logic of this model says, if you can't meet A, B, and C, which are the first 3 obligations, then draw on the revolver. So there's a bit of a tension there of, what happens if you try to draw on the revolver and there's not enough left. The answer, as it turns out, is that this cap doesn't come into play. With the model assumptions, you don't ever get to 5 million or even particularly close. But yeah, I remember at the time kind of sweating a little bit about, like if you're modeling a cap, then you also implicitly have to model what happens if you breach the cap. So anyway, like I said, the answer in this case is you don't have to. The interest rate for the revolver is 7% plus NIBOR. So let's just do this. The opening is going to be this big fat 0. Grab my format from up here and paste it. Closing some of these, opening the next year, copy across, and copy across. Then my interest rate is going to be, again, up to NIBOR, way up here, plus that spread, 7%, and copy across. And then okay, so then the next thing we'll do is the waterfall, and that'll help us figure out. So we start off with our CFADs. I'm just going to link back up to here so I have it where I can see it. And then let's talk about what are the obligations. So first, mandatory operational expenses already included in getting to CFADs. Second, debt interest payments. So interest. That's going to be senior debt is up here. Oh, that's subordinated already. Senior is here. with a minus, obviously, minus the subordinated debt, which is down here, and then minus the revolver, which is down. Oh, I haven't actually done interest for the revolver yet, so I'll just do that, quickly fix that. Interest rate. Oh, sorry, no, I've done interest rate. Interest. And again, it's just the opening balance times 7.5% divided by 4. Copy that format and copy across. So that's my interest. So that's B. Then step C, mandatory debt principal payments for senior and subordinate debt. So mand repay. And again, I'll come up here. Here's my mandatory repayment on the senior. Already got a negative sign, so that's good. And here's my mandatory repayment on the subordinate. Already got a negative sign, so that's good. So then, so you'll see we need to get as far as A, B, and C. And if we can't meet that, we have to draw on the revolver. So, and I'm going to have an interim calculation, which is cash pre-revolver. Just sum up that. My light just went out. That is not great. Oh, I feel like I've committed now. I think I'm just going to finish this in the dark. And sorry if that seems a little weird to you. Okay, anyway, sorry. Cash pre-revolver is this one. So then in this case, I've got a negative I need to draw down. In this case, I'd be able to repay, and you can see that the next item, D, is revolver principal repayment. So, to from revolver. And that is going to, well, hang on, let's just see. So let's do available revolver balance. Actually, no, I'm not even going to, I might, yeah, I'm going to, available revolver. I was debating whether I should even factor in the cap because it doesn't get used, but it makes more sense to factor it in. So that means that I want that over 1,000 minus whatever's already drawn, which is going to be up here. The opening, so that's C38. Sorry, and I have to lock this in, otherwise it won't copy across right. Good. Okay, so then let's say revolver draw. You can do this all in one formula, how much is drawn plus how much is repaid if you're feeling brave, but it's safer not to. So that is going to be, if this is less than 0, then the min of minus that. So in other words, this is less than 0, so I need 179 to make it whole, and the most I can draw is whatever's left on the revolver, so that's that. Otherwise, 0. Let's just copy that number format down a little bit more and fill across. So that's how much I draw, and then how much do I repay? And that is going to be equals, if this is greater than 0, then I repay the whole amount, opening balance, up to a maximum of the amount of cash I actually have. And otherwise, I don't repay anything. And then we can link these up into the revolver. So the drawdown, except we need to flip the signs, because the thing that helps your cash hurts your revolver and vice versa. Copy that across. And now what we see is oops, that's the wrong way around. It's not good. My drawdown. Sorry, yeah, I should have kept the signs the right way around, because they already were. Okay, so copy that across. Something's looking pretty funky over here now because I've got 320 million on my revolver, so I'll have to check on that. But for now, let's focus on this. So we need 179 to meet our payments, so we draw that down. We repay nothing. That's all good. And then next period, we should be paying 179 back. Okay, yeah, this is what's going on. I should have made this a negative sign. So now it should balance out. So let's step through it bit by bit. So we draw 179, so you can see there's 179 less available to draw in the next period. And in the next period, we've got a balance here, and we should be paying a little bit of interest there, which we are, so that's all good. sorry, yes, that interest rate is supposed to be going up. That just looked a little funny for a second. Then the next period, we've got a bunch of cash coming through because Q1 and Q2 we generate more cash flow. So we pay off the revolver, and then a little while later we go negative. So we draw down again, draw down some more, then we pay it all off in the next one, and so on. So basically, in the second half of the year, where we only get 20% of the CFADs, we don't make enough to cover our costs, and then we pay it off in the other half of the year. So net to from never mind. So cash post revolver. That's going to be your cash pre-revolver plus that plus that. So in other words, I have 0 closing cash, and it specifically mentions here somewhere down at the bottom. For simplicity, assume that at the end of the quarter the remaining cash balance is 0, no mandatory reserve. Otherwise, you might have a bigger amount you needed to draw to have whatever $100,000 minimum cash balance or something. But in this case, we don't do that. So cash post revolver is that, and then if this is working, it should work out as 1781 there, and it does. Okay, so those formulas seem to be working. That's cash post revolver, and then of the remaining funds, 60% distributed to equity, and the other 40% are used for accelerated repayments and then to equity in the following order. So this is cash post revolver, so then the draws on that are to equity, and that's, again, that equity assumption is over here somewhere. Always got to link back to your assumptions tab. It's there, the dividend rate. So we're going to say equals minus that times this. Oops, there we go. Copy that across. So we're paying out most of it. Yes, that seems to be working. So then the next piece is the subordinated debt. So, whoops, Excel subord. Again, I would have a little more space, but, well, I've made my excuses already. I'm not going to keep doing it. So we're going to say equals, we'll start at one where I actually have money. So equals minus the minimum of, whoops, so the most that I can give out is the total amount of money that's not given to equity, and then I will never give out more than the amount that's actually available to repay, which is this. So in this case, there's going to be 68 million left to pay, and there's going to be 700,000 left to pay it with, so that all goes there. And that will, yeah, so that'll keep going. Now the important thing is, now that I've done that, I have to go up here and link that in. So accelerated repayment goes here, go all the way back down to the bottom. So now I have my accelerated repayment. This is where I mentioned earlier that the Q2 repayment, we were looking at $1 million, but that depended on the repayments. So now, if I can even read this damn thing in the dark, I should have 989,522 for this one. So let's see if that's what I have. Yes, it is. Good. Happy days. And then I copy that the rest of the way across, and you can see that means we end up repaying this debt a chunk sooner. So let's see how many we end up with. 42 periods instead of 70, so that makes a pretty big difference. Okay, so having done that, our next piece is accelerated senior. And again, it's basically the same thing as this, except now we're going to take away whatever's already been spent on accelerating the subordination, and we're going to reference this to the senior debt instead of the subordinate. The senior debt is up here, so it's that plus the mandatory. So there's nothing there, and here you can see we've already spent all the money on that, and that should continue to be the case. There shouldn't be a cent on this line until that subordinated debt is fully paid off, which happens over here. So let's go here, and then once that is fully paid off, then it starts all going on that. So again, you can see those all add up to 0. All the money is being spent on that until such time as that is fully repaid. And then again, we just need to link that line in here. So we jump down all the way to the bottom, link that in there, copy across. So now we can see at some point, 42 periods in, I think I said it was, this starts accelerating. So just double check that is 42, yes, 42 periods in, good. So then that starts accelerating a few million every quarter until it is, I mean, it's already largely paid off by that point, but then it closes out pretty quickly. And then last thing in the waterfall is when all debt instruments are fully repaid, excess funds are distributed to equity holders as well. So we'll just call this to equity 2, and we'll call this to equity 1 to avoid confusion. And that's just going to be equals minus sum of all this. So just whatever's left, which again, there should be nothing left for the senior line until we're completely done with the subordinate line. There should be nothing left for the extra equity line until we're completely done with repaying the senior debt. And that is indeed what happens. So we go all the way across there. More money to equity. So let's have a quick gawk at the questions again. How many quarters will the interest rate for the subordinate debt be? 12.5%. So I should have really done the questions a little more like real time, but never mind. And the answer is supposed to be 19. Let's see. Over as far as here, and count is 19. So yes, that's good. What is the total interest paid for subordinate debt? That's going to be down here. Sum of 40953. That's good. What is the maximum outstanding balance on the revolver over the 20 years? Should be 1.693. Whoops. Come down here. Closing balance. Max 1.693. Happy days. Total amount of accelerated repayment for senior and subordinated debt should be 50,523,000. So I've got them both together down here, so I can just add them up, and it is 50,523,000. Happy days. Total interest paid on all 3 instruments over the 20 years. I've got this handy line right here that does that. Interest here. And that is 122,406, which is what it's supposed to be. Total amount of distributions to equity. So that's going to be the sum of equity 1 and equity 2, which is this. And this 545,039 is good. Okay. What is the equity IRR of the project as of September 30th, 2019? Use XIRR. All right. So I didn't actually end up using this blank column for any helper stuff, which I thought I was going to, but the nice thing about it is it does let me plug in this extra, the transaction date. So it mentions somewhere in here. Yeah, here we are. The project's equity was fully invested 2 years ago at the beginning of construction works on September 30th, 2019. So again, I'll just copy that format there. So again, it's a different formula from the rest of the row. And then all the cash flows occur at the end of the quarter, so that's why I'm putting it in line with here. So just jump down to the end. Equity, I guess I should really make this a section, since I'm semi-formatting this. So equity, cash flows. And I suppose if I'm being very diligent, I would say, yeah, fine. Investment. And that's going to be this guy, over 1,000. And I'm going to HFC, make that red again, because it's a different formula. And then returns. That's just going to be the sum of these two. This guy plus this guy. So you get 545 million returns on an 80 million investment, which doesn't seem too bad, but let's IRR it. So XIRR, sorry, I need a total cash flow line, which is going to be the sum of these two. So XIRR calculates, well, let me take a step back just in case you don't know it at all. IRR, internal rate of return, is what discounting rate would you need to apply to all these cash flows so that they net out to 0. So discounting rate meaning, you know, cash flows a year from now are worth 8% less, another year from now are worth another 8% less, as in 1 divided by 1.08 rather than minus 8%. And XIRR helps you figure out the exact rate that will net that out to 0 based on exact dates and based on interest over 365. So in other words, interest, you know, between periods based on the number of days, which isn't actually the same convention as we used for the rest of it, but whatever, that's what they told us to use, that's what we're going to use. So values, and I'll say it before I complete the formula, the answer is supposed to be 12.89%. So cross your fingers, and maybe we'll get it right. Oh, that's terrible. That's really bad. Oh, sorry. Yeah, that's because I made that minus 80. So yes, I got to be consistent with my sign conventions, otherwise there is no IRR. So fill that across. Ho ho, that looks good. 12.89%, hooray. And then the very last bonus question is, what is the company's best strategy regarding the distribution of funds left after mandatory payments? So in other words, if we go up to this piece here, cash post revolver. Right now we say 60% goes to equity, then we do the subordinate loan until it's paid off, then we do the senior loan until it's paid off, then we do to equity. And it offers 3 different alternate strategies. 1, distribute all the cash to equity holders as soon as possible. 2, use all the free cash to pay back all the debt as soon as possible, as there are no early repayment fees, which I guess is the one we've already modeled. That's giving all of it to debt rather than 60% to equity. And then 3, use all the free cash to pay back subordinated debt until the point when the interest rate drops from 12.5 to 6.5%. So if you remember, we had this like super punitive rate on the subordinate debt. Sorry, where am I? Oh, the screen is so small. Okay, we have this super punitive rate after the first year until our debt to EBITDA ratio gets down below 4. So you can see a logic that you would pay that off until it was gone, and then pay everything else. Now, you can relatively easily model this, but I think this video is already quite long enough, and maybe longer than I wanted it to be. So I'm not going to do that, but I will tell you that if you put your corporate finance 101 hat on and think through it, if the equity IRR is 12.89%, then you can basically think of it as the return you get on paying off debt is going to be the debt interest rate, which is never more than 12.5%. The return you get on giving money to shareholders is going to be 12.89%. So in other words, the highest return, and hence later the thing that will turn back into that IRR being an even higher number, is distributing all the cash to equity holders as soon as you can. It would potentially be different if the punitive rate started off just a little bit higher, because they're not that far apart at 12.5, 12.89. And that's it. So, yeah, I think I actually got it all right. So, hooray. It's one of the risks of doing this live, is that, I might have to set off on a bunch of debugging if I'd made a mistake. So, like I said, it's a little bit of an experiment. I'm very aware that you can only see a tiny portion of my screen, and I don't know how that works when I'm jumping around. It'll obviously be easier to follow if you either have tried this case yourself, or if you have the materials on your own computer and can kind of look at them in the next window or something like that. And I will post the link to where you can get the materials below the video. But yeah, like I said, I kind of wanted to try it out because I know a lot of people have asked me about doing kind of actual financial modeling, because it's something that a lot more people need to learn for their jobs than how to model poker and baccarat and other things that I might find more fun to spend my spare time on. So I'm going to try and do a bit of both. But like I said, I'd be interested to hear, did it work? Was it too small? Was it too hard to follow? Let me know in the comments, or find me on LinkedIn, email, or the many other places that I exist. That's all I got. If you're competing in the FMWC this weekend, then good luck, and I'll see you guys next time.